Hello, I'm Richard Crump. Welcome to the latest Friday afternoon live with Accountancy Age. We're back in the Comedy Store today. Kevin Reid is away, so you have me. Really, it's another week and another set of botched accounts and allegations of financial accounting mismanagement. I could be referring to Kids Company, which this week kind of closed its doors amid accusations of financial mismanagement, warnings over lack of reserves, which were not heeded by the trustees of the charity, which subsequently put strains on cash flow. Now, these warnings over a lack of reserves, really building up over time, have been pretty much dismissed by Alan Yentob, who is chairman of the board of trustees there. He dismissed them as absolute rubbish. But it isn't actually Kids Company, which if you want to read more, you can check on Financial Director, that I'm referring to. I talk, of course, of Quindell and its auditors, KPMG and Tenon Audit Limited. Now, it turns out that some of the problems about Quindell have been well trailed, but this week Quindell, restated its accounts. The company said its revisions of how it accounted for claims management sales had hit its revenues and its profits after tax by hundreds of millions of pounds. There are also corrections to how it accounted for its acquisition of Quindell Limited. And really, a lot of these things were confirmed hours after it revealed that these things led to a plunge in its profits last year, as it slashed the value of reported net assets. Now, the issue is that the FRC are now facing, or the KPMG is now facing, an investigation by the FRC over its audit work during the time while the Serious Fraud Office have launched a criminal investigation into the business and accounting practices at Quindell. Now, a lot of its accounting treatments were at the aggressive end of what is acceptable practice, and it's understood, obviously, KPMG may very well have raised these issues in previous accounts. But once again, the sheer scale and number of accounting misstatements and errors that were made raises questions, or just casts another bad light on the role of auditors in vetting, companies' accounts. Now, I think the frustration must be for the profession that the majority of audits, 99% of them, are going to be good, well conducted. It's only the few that make the headlines that kind of cause the perception of the profession to be such. An auditor once remarked to me, probably a well-known joke, that doing a good audit is much the same as wetting yourself. You get a lovely warm feeling and no one else knows that you've done it. The problem is with so many public examples of this, with trust in businesses such a low, from Toshiba to Tesco's to everything, is akin to the auditors actually urinating in public. It is very much a public offence. But there are so many other good things going on. In terms of the extended audit reports, and elements of this will cast more transparency on the process and the actual issues that are raised by auditors to management at the end of the day. As an aside, looking at the audit market, I was recently speaking to a senior audit partner at a Big Four firm, and given the changes in the market, which seem so much more business changing hands, the actual war for talent at the very highest level has increased exponentially. This audit partner suggested that they've been on the receiving end of some pretty aggressive tactics by other Big Four firms trying to poach either people at partner level or just below, as they look to bulk up their audit teams and specialist capabilities. This is similar to other things we've heard from Big Four firms, so clearly, which was not so much common to see at partner level amongst the Big Four changing hands. We may see this happen more often in the audit space. Staying with KPMG, aside from its role as auditor of Quindell, the Big Four firm recently confirmed an alliance with the peer-to-peer business lender Market Invoice as it steps up its move into the small business services. Now, KPMG has made a great play in recent months of its moves into the SME market, and in October last year invested $40 million in its enterprise offering, and Deloitte too has also become the latest Big Four player to make a concerted effort with its strategic partnership with Sage, which we mentioned here last week. I think it's interesting just to see how the Big Four focus on the SME market, which hitherto may not have been as lucrative as, say, a 40 million Barclays audit, 35 million HSBC audit. But clearly, changes in technology and the opportunities Big Four firms have to harness their scope and scale, especially if they have advanced back-office cloud offerings, means they can now provide services, cheaper services, to an SME market that they wouldn't have touched before. I expect to see a lot more of a play in this area. Now, looking at the world of tax for a bit, It seems that human rights and tax avoidance are difficult bedfellows. It's turned out twice in the past week that challenges made against tax avoidance, using human rights as an argument, have essentially been thrown out. Now, there's a big win for HMRC, whereas it's challenged by investors in ingenious media film partnerships over the legality of accelerated payment notices, which have proved mildly controversial, was comprehensively rejected by the High Court. Now, the investors did claim that HMRC APNs were unreasonable and they breached natural justice, represented an abuse of their rights under the European Convention of Human Rights. This was thrown out by the High Court. And just the other day, an attempt to have stamp duty land tax anti-avoidance laws declared unlawful was also rejected by the High Court. Once again, human rights was the argument of why they're unlawful. Clearly, that argument doesn't seem to be winning out. And finally, it's worth mentioning is the football season starts. Now, I know England are currently thrashing Australia in the cricket, but the football season does start next week. Why is this relevant to accountants? Well, it's kind of relevant to FDs. BDO recently published a report looking at football finances, and the interesting thing they found is with the advent of financial fair play and the $5.1 billion rights deal to broadcast Premier League matches, it actually could cause clubs to adopt a more traditional business model. That means sustainable profitability, positive cash flows, investor returns, as well as enhanced value for money, something that might have seemed foreign to a lot of FDs working at football clubs. But for the time being, sustainable profits are not here. The clubs, on the basis of the money coming through, are sacrificing short-term profits in order to ramp up spending ahead of the new season. We've seen that with some of the mega deals taking place. Now, it will be interesting to see whether football clubs, on the whole, will adopt the traditional business models of the other companies maybe in the FTSE. But given some of the governance scandals we see at the moment, whether that's such a good thing after all, well, we'll see. Hopefully that's given you some food for thought today. So look forward to seeing you next week. Kevin will still be on holiday, so you'll be stuck with me again. See you then. Cheers. Bye.